Ladies and gentlemen, good day and welcome to the Radiant Cash Management Services Q2FY26 earnings conference call hosted by Antique Stock Broking Limited. As a reminder, all participants' line will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Raju Barnaval. Thank you and over to you, sir.
Thank you and welcome everyone to Q2FY26 earnings conference call of Radiant Cash Management. Today we have with us the management of Radiant Cash represented by Colonel David Devsahayam, CMD sir, Mr. Alexander David, Whole-time Director, Mr. Venkataraman, CFO, Colonel Ben Jacob, CEO, and Mr. Muthuraman, Strategy and IR. With this, I hand over the call to MD sir for his opening remarks, post which we'll start the Q&A session. Thank you and over to you, sir.
Good morning. Thank you, Raju. Good morning, ladies and gentlemen. Thank you for joining us today for Radiant's investor call. At the outset, apologies for not holding the analyst call at the end of the previous quarter due to certain unavoidable commitments. Let me assure you all that from here on, we'll consistently hold the analyst call at the end of every quarter and provide transparent updates on the developments in the company. Coming to the performance for this quarter, our standalone revenues were nearly flat over the same period last year at about rupees 1.02 billion. Our EBITDA margins are lower at 14.9%, mainly on account of losses in the valuable logistics segment and secular increase in our fixed costs. Volume of cash handled during the quarter at rupees 0.41 trillion remained flat over the same quarter in the previous year. We are taking several measures to improve the revenue growth and restore the profitability to past high levels. I'm highlighting the key measures below, which I believe would start yielding results in the coming quarters. We have started offering a wider array of services to banks to capture a higher wallet share. These include cash sorting machines, ATM replenishment through cassette swap, cash deposit machines, and an increased thrust on cash van operations. We have strengthened our direct clients business, which has continued to grow at a healthier pace and now constitutes 15.7% of our standalone revenues. We have initiated strident cost reduction measures across every region through rigorous benchmarking of several productivity measures, which is expected to reduce costs to the tune of rupees 50 million on annualized basis at current level of operations from the third quarter onwards. A strong focus on achieving growth and break-even in valuable logistics segment has resulted in near doubling of revenues in this division, though on a small base. While costs have increased correspondingly in this quarter, on account of a few senior hires and new routes for marquee customers, we are confident of significant improvement in gross margins and achieving break-even in the current financial year. Onboarding of a distributor network to handle low cash volume points with the help of technology, and lastly, a significant thrust on improving transaction volumes in our fintech subsidiary Ace Money, which carries better margins and provides more sustainable revenue streams. At the same time, our core business of cash pickup and delivery continued to grow at a muted pace in this quarter due to lower trust of banks and pushing cash management services at this point to their clients. We have strengthened our sales teams across all business verticals and launched several new initiatives in sales and marketing to improve the core business volume. At the same time, significant improvement in cash volumes handled was witnessed in the current quarter. That is the third quarter on account of the recent government initiatives to boost consumer demand through reduction of GST as well as the extended festive season. In terms of operations, our cash losses continue to be the lowest in the industry because of our robust risk management framework. We continue to expand our geographic footprint with over 15,000 PIN codes and close to 9,000 locations, which is helping us maintain our market leadership in the retail cash management segment of the cash logistics industry. We remain committed to providing transparent updates on our progress and answering any questions that you may have. I will now request Mr. Muthuraman to speak about the progress achieved in Ace Money, followed by Mr. Venkatraman to speak about the financial performance and KPIs.
Thanks, Colonel David. Good morning, everyone. Thanks for joining this earnings call. I'll be presenting the update on Radiant Ace Money, our fintech subsidiary. After a sharp drop in revenues and significant losses in Q1 due to a vendor transition issue which we highlighted earlier, Radiant Ace Money has bounced back and reached revenues of 49 million for this quarter, up from 17 million in the previous quarter. Due to extended impact of the disruption in the first few weeks of this quarter, the performance is still below the delivery capacity and market potential for this business, resulting in EBITDA level losses of 15.6 million for this quarter. The business has now come back to healthy profitable levels, and we are confident that Radiant Ace Money will fully wipe out the losses incurred in the first 6 months and contribute meaningfully to the overall profits of the consolidated entity in the remainder of the year. I'd like to present a few numbers to put our performance in perspective. We have installed 14,000 plus POS machines in this quarter and working towards achieving an ambitious target of more than 1 lakh machines for the current financial year. The team used the vendor disruption period to increase trust on transaction volumes, which has yielded results. We clocked transaction volumes of almost 400 crores in this quarter, and transaction revenues now account for almost 25% of our revenues in this quarter, up from an insignificant share in the same quarter last year. I'd like to highlight here that the final aim of this business is to enable transactions at the grassroots level, particularly in Tier 3 and beyond, which will help achieve real financial inclusion, besides providing us with a sustained annuity revenue model. We are also in the process of developing many of these retail outlets into business correspondents to provide a much wider variety of financial services, including accepting cash from our retail cash management business at competitive rates to help grow the core business of the consolidated entity. We are continuously expanding both our geographical footprint as well as service offerings to address the untapped markets in rural areas where digital access is still below 50% for merchant outlets, providing huge opportunities for growth. The remaining quarters of the current financial year are quite promising, both in terms of revenue growth and profitability. We'll continue to provide regular updates on the progress of Ace Money to our investors as we scale greater heights in the coming months. I would now request our CFO, Mr. Venkatraman, to present our financial performance.
Thank you, Muthuraman. Good morning, everyone. Thanks for joining us on this investor call today. I will present the company's key performance indicators and financial performance for the quarter and half-year ended September 30, 2025. Coming to business performance, during the financial year so far, we added 10 new clients and 120 new end customers in our retail cash management business. At the same time, we had a drop of 2,364 points in the last 6 months, mainly on account of loss of few regions of railways and loss of one major e-commerce logistic client who got acquired in this period. In this half year, we handled 0.83 trillion of cash, a growth of 1.3% over same period last year. As a result, the overall business has remained flat at rupees 2 billion for this period. At the same time, I would like to highlight the fact that today we service more than 75,000 touch points, covering approximately 14,500 PIN codes across 9,000 plus locations and continue to have the widest network in the industry. In terms of segment performance, we witnessed healthy growth of 30% plus in e-commerce segment and 24% in petroleum segment, while railways and e-commerce logistics reported more than 50% drop in this quarter compared to the same period last year. The share of direct business continued to improve and now account for 16% of our cash management revenues as against 13% in the same quarter last year and 4% the year before. Our diamond bullion jewelry segment has grown at a healthy pace in top line this quarter and have added few marquee customers with significant growth potential. At the same time, our costs, particularly related to air cargo, have also increased, resulting in continued losses for this quarter. The senior management team has been strengthened and the routes have been consolidated, and the management is confident of achieving break-even in this business vertical in the current financial year. Consolidated revenues for the quarter were rupees 1.07 billion, representing 4.6% growth over the previous quarter. Consolidated EBITDA margins for the quarter stood at 13.1%, an improvement of 150 basis points over the previous quarter. The improvement in EBITDA margins in this quarter was achieved on account of three factors mainly. One, strong focus on cost control. Two, reduced losses in Yes Money, our fintech subsidiary, which suffered in the previous quarter due to a one-time vendor displacement shock. Third, healthy growth and contribution from our cash van operations. The management is confident of significant improvement in margins in the remaining quarters of the current year. Radiant continues to have very low cash losses from operations, well below the industry standards. We are one of the lowest cash losses in this quarter, a reflection of our strong risk management practices. In summary, the revenue performance for the year has been muted due to company-specific factors highlighted earlier, as well as due to extended monsoons. Despite muted revenue growth, EBITDA margins have improved due to strident cost control measures undertaken by the management. The management is working on several sales and marketing initiatives across all verticals: direct sales, diamond bullion jewelry business, cash van operations, in-stock rate, and our core business of retail cash management, and we believe these measures would reflect in better growth and margins in the remaining period of the current financial year. I now hand over the floor for question and answers. Thank you, everyone.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Abhishek Chawla, an individual investor. Please go ahead.
Hello. Good morning, everyone. Just a bookkeeping question. In the cash flow statement, when we mention fund held relating to cash management activity, could you just share, is this the cash that the company's cash that is being for the rotation, or is this the client's cash?
It is the client's cash. No.
Sir, this is what the client cash is already netted off. If you see a note in that,
the cash in bank.
In the notes in our annual reports, if you see, the total gross cash minus what is belonging to the client is netted off, and what is this is a net amount which belongs to Radiant Cash Management, but it is not free cash, but is used in day-to-day operations of the company. This will be cases where we fund the client on the same day, but we get credit the next day, or where we use it for during holidays or evening pickups, etc., or wherever we do the cash burial. These are the instances where our own cash is used, and also in cases where low denomination notes and coins are collected, we accumulate that and then dispose of subsequently, but we fund the client for the full amount.
Got it. Just that's it. Thank you.
Thank you. The next question is from the line of Madhur Rathi from Counter Cyclical Investment. Please go ahead.
Thank you for the opportunity. Sir, I'm relatively new to the company, so I wanted to understand, sir, what has led to our margins declining from close to 27-28% to 12-13% for the past 3 quarters?
Yeah, hi. I'll answer this in 2 parts. One is specifically for this quarter and a generic response as well. One is that specific to this quarter, the losses in our Radiant Valuable Logistics affected our overall margins. There's also been an increase in cost of guards and drivers and a nominal increase in salaries. As we had explained in the past, ours is a high fixed cost and high operating leverage business. So when the revenue grows, costs do not correspondingly increase and results in better EBITDA margins. But absence of revenue growth has had the exact counter effect. So when the revenues are flat, the costs nominally increase typically 7-8% to account for cost of living, and guards and drivers specifically at a slightly higher rate because of market conditions. So that has affected our margins at the core business level. The losses at the RVL added to a higher loss at the standalone level, and some loss in the Ace Money because of the vendor disruption resulted in lower margins at the consolidated level.
Got it. And sir, if I look, sir, so what would it require for us to reach the 25% plus margins that we used to do earlier?
Yeah. Again, in three parts I'll answer. One is that the Ace Money was a one-time disruption. We are confident that it will contribute significantly to the overall profit for the remainder of the year. So that should help improve the consolidated EBITDA. We are confident that the valuable logistics will achieve break-even in the current financial year. So the reduction in losses again will help improve. The key reason how our EBITDA margins will restore back to the 25% levels is when our revenue growth for the core business hits the mid-teen levels of rate. And there are company-specific factors which Mr. Venkatraman highlighted, which affected that. This thing, management is conscious of it and taking measures to restore our core business growth.
So for rest of the FY26 and FY27, sir, can we expect to grow at the mid-teens kind of revenue growth when we can achieve a margin improvement?
Definitely there will be a margin improvement, both the revenue growth as well as margin improvement. October festive season has been fantastic as you would have seen in many other companies as well. So same is the case for us. October has been good. We're expecting that the trend will continue and we will report definitely much better margins than the first half of the year.
Got it. Sir, just final question from me, sir. Our competitors, they have mentioned that they have got a big quick commerce client to their business. Sir, so do we cater to quick commerce segment and or we are still not present in that segment, and if not, can we expect a client addition in that segment?
No, we do have quick commerce clients in our client portfolio as well. Yes.
And sir, is this a segment that we think can become big over the next 2 to 3 years, or retail cash management will be the dominant segment for us?
No. I think your question is wrongly framed. The retail cash management service that we offer to quick commerce clients is providing some growth. It is not that we are getting into quick commerce and doing delivery of anything other than cash. So even I think the competitor also is providing cash management services to quick commerce companies, e-commerce companies, e-com logistics companies, and BFSA and several other sectors. At this point of time, BFSA is our largest segment, followed by organized retail. These two will be driving our growth. Yes, e-com also is driving our growth, and quick commerce also will continue to drive our growth. In fact, this quarter, just now CFO mentioned, we had almost 30% growth in revenues from e-commerce segment.
Got it. And sir, just a final question, sir. We have 242 crores of cash on our books as of H1 end. Sir, so how much of this is pertaining to our clients and how much is pertaining to Radiant's own business?
No. 100% of it is Radiant's own cash. Nothing is a client's cash cannot enter into our balance sheet.
That's right. Because the cash balance, what we have shown is after netting of the client's cash balances. It's our own cash.
But it is not entirely free cash as I explained. but it is not entirely free cash as we explained. We have given a breakdown of that in our balance sheet in annual reports.
Yes.
We don't do that in quarterly statements.
That's right.
You can say roughly about half of it will be free cash.
Okay.
About
Sir, that was...
free cash.
Sir, I didn't get that. Sir, please can you repeat?
See, about 75 crores will be our free cash.
Yeah. Sorry about that. Yeah, not half of it. 75 crores is free cash. Rest of it is cash used in cash management activities for funding evening pickups, for funding holiday pickups, for funding low denomination notes and coins, for funding same day, day zero funding, etc. And also margin money towards bank guarantee that we have provided to banks.
Okay, sir. Sir, that was from mine, sir. Thank you so much and all the best.
Thank you. The next question is from the line of Gurav, an individual investor. Please go ahead.
Am I audible?
Yes, please.
Thank you for the opportunity. So I had a few questions. Number one, the first question that I had was more towards macro-centric view. From where I understand the volume of UPI transaction has been increasing and the digital penetration in India has been increasing. So I just wanted to understand an outlook or a viewpoint that you see from your business and the volume and a decline in volume that you foresee in the future.
Okay. See, the growth in UPI is been happening alongside the growth in currency in circulation as well. So the currency in circulation, even if you see the latest data as of August 2025, it is almost 38 lakh crores, a growth over same period last year, almost 8% growth over same period last year. So currency in circulation continues to grow, and it will continue to remain at about 12-13% as a percentage of GDP. So as the GDP grows, currency in circulation will continue to grow. So that is not a serious challenge that we are facing. The bigger opportunity for us is that we are hardly catering to a very small share of the transactions that happen in cash. And significant number of banks, particularly public sector banks, not yet offer this as a service, the doorstep banking as a service to their customers. So we are doing a direct sales to customers, and today direct sales is about 16-17% of our revenues, and we expect it to continue to grow. So there is no major challenge on account of growth in the digital transactions in the country.
Got it, sir. That was really helpful. And the next question that I had was, so I just want to understand the targeted EBITDA margins that you're looking for, because in the current quarter, from where I can see is we have improved from 11.6 to 13.1% sequentially. So how do we see in going forward in Q3 and Q4? Because catching up with the festive season, I think there should be some positiveness circulating in the market. I just wanted to have a viewpoint and understanding on that.
We have not put out specific number guidance for the remainder of the year as yet. But definitely the trend line, what you saw between first quarter and second quarter, it will definitely sharply improve. What we had said in our earlier analyst calls is that, as in a sense, 27, as in the next financial year, our hope will be to reach our past historical high levels, which is about 25% EBITDA margins.
Got it, sir. That was really helpful.
Thank you. The next question is from the line of Zohair Hussain Nasir from Nasir Investment. Please go ahead.
Hi, am I audible?
Yes, sir.
Yeah. Thank you for the opportunity. Could you? My question is on the payments aggregation and digital payments solution line of business, which was announced along with the result. Could you elaborate on how this business will align with the Ace Money's current product suite, and what strategic synergies do you see between these two businesses?
So the strategy that we have, I'll answer it in two parts. What is the Ace Money's standalone growth strategy and the linkages with the core business of Radiant Cash Management. So the Ace Money's own growth strategy is one to increase its footprint. Today we already have almost close to 1 lakh POS machines outstanding. In this quarter, we did 14,000, and our this year target is incremental 1 lakh machines for the current year. So that is the rollout of the POS machines is the stage one. That is the first stage revenue. Then help improve transaction volumes from these POS machines. We do have almost current quarter 25% of our revenues is from transaction volume. But as the number of POS machine target is ambitious, this share could slightly go down, but the volume of transactions at 400 crores for this quarter will significantly improve as in the rest of the quarters. So this is the second level of revenue streams. This is more like an annuity stream. The third level is that roughly maybe 15-20% of these POS machines, these retail outlets will translate into business correspondents based on the volume and maturity of that outlet, etc., where we can offer a much wider variety of transactions, Aadhaar-enabled payment systems, bill payments, domestic money transfer, cash withdrawals, cash deposits, statements, etc. It is like a mini bank. So these, each of these POS machines will, at least the 10-15% of them will function like a micro ATM. So with the much wider variety of services, including other financial inclusion services like micro insurance and bank account opening, etc. So this will give much higher unit volume for the retail outlet as well as for Radiant Ace Money. So that is the third stage of maturity as we go along in the Radiant Ace Money's own growth strategy. Now coming to the second part of it, where we see a synergy between between our core business, is that as we have said in the past, we have lost some part of the business in the core business to payments banks, where these business correspondent outlets have been used for cash collection. So our own network will help us win back those points and also offer this as a service. Particularly, this is workable only where the transaction volumes are low, where the vendor or the retail outlet has a wallet balance and they are able to provide those instant credit to the merchants. So that is where we are hoping that the synergy benefits will work out over the coming quarters. Hope this answers your question.
No, I just wanted to understand on the digital payment solutions business, the new line of business that you announced with an investment of 3 crores. How would this significantly be different from Ace Money? No.
So there's a regulation which mandates that this business cannot continue without a payment aggregator license. Today we are working with a few banks, where bank has a BC model, bank has a payment aggregator model, BAPA model, but that will not, RBI has said that they will not allow that business model to continue, and payment aggregation players like Ace Money have to obtain a payment aggregator license. So will require a payment aggregator. So that is why that has been done, as in by next 2 quarters, we hope to have that license and then roll out. Continue to do the same business. Whatever the business strategy that I have indicated requires beyond a particular cutoff date will require a PA license, and that is why that initiative has been taken.
Thank you, sir. All the best for the remaining year.
Thank you.
Thank you. The next question is from the line of Vikas Kasturi from Focus Capital. Please go ahead.
I think the line is not active. We can move to the next question, please. Operator?
Raju, you're there?
Okay, sir. A reminder to all participants that you may press star and 1 to ask a question. The next question is from the line of Vikas Kasturi from Focus Capital. Please go ahead.
Good morning. Am I audible?
Yes, Vikas. Good morning.
Yeah. Good morning, Muthu sir. Sir, I had a few questions. The first one is about the drop in railways business. Is that like a one-time thing? Is that something that is temporary, or is that like a trend that you are seeing?
Okay. So our business from governments are hardly there. This is one such segment where, because of the adverse pricing and because of very long payment cycles, we decided not to pursue this aggressively. There are no other major government businesses that we are dependent on through RFP model. So it is more one-time in nature.
Got it, sir. Sir, and could you please elaborate a little more about what happened with the ACE money? There was some vendor shock, something like that, which you described, but I did not understand that issue. Could you please describe that for me, sir?
Giving that much detail as I would like to in a public platform, we'd like to say that the vendor we were operating with, there were some issues, and due to which we had to move into another couple of vendors, which we have done now. And that's the reason why, it had an impact on the first 2 quarters. But as we are seeing right now in October and also towards the later part of the second quarter, we are well on our way to recovery and also to overcome whatever negative performance might have happened in the first half.
Got it, sir. Sir, on a related note on ACE money, you described what the business correspondent does. And I was under the impression that we were already providing those kind of services through our ACE money business. So if that retail outlet is not doing BC kind of activities today, then what is the kind of service that that retail outlet is providing, sir?
No. So let me just clarify. Of course, we do have BC's network today, and we also have the merchant network today. So if I install a POS machine in a tier 3 location in a small shop, that is the first digital payment access that he is getting to accept cards, to accept any form of digital payments, QR code and everything. So that is the first level. But if the shop is too small, he may not be in a position to attract several other transactions like other-enabled payment system or cash withdrawals or cash deposits, etc. Only 10 to 15% of the merchants will be big enough to become a BC.
Got it.
So today we have both BCs as well as merchants, but the total base is small. As we roll out more machines, we will be able to get a much wider network of BCs.
Got it. And in the past, you had indicated that the synergies with our cash management businesses, that in the cash management business, you are transporting cash, and some of that cash can be given to these retail outlets for their BC kind of activities. Is that correct, sir? Is my understanding correct? So
that is correct. This is in specific pockets where there are outlets where they distribute significant amount of cash withdrawals, and their own balance in their till will not be sufficient, where we may have to replenish that. It is still too nascent to have meaningful impact on us, as in the sense our network is small, and this is a longer-term synergy that we see between retail cash management and the BC network.
Okay.
At this point of time, that number is very small.
Okay.
I'll add on to that the current utilization of MATMs is not so strong that the money availability at the outlet is diminishing or is not available for the customers. But as it becomes more popular and the volume of these transactions increase, and when there is a requirement of cash to be replenished, then the fact that we have so much of cash available in the hinterland is going to be a definite strength compared to any other fintech player who does not have the same facility.
Got it, sir. So if I understand it correctly, sir, the way you are thinking about it is like you're setting up the infrastructure right now, and if and when the volumes increase in the future, then you will be in a position to you will have more recurring revenue through that.
Yes, if you see the kind of revenue that currently over 60% of our revenues comes from the tier 3 plus locations. So we have a presence in the extreme hinterland, the bottom of the pyramid, so to say, and now with also a strong fintech orientation, we are becoming a truly strong hybrid platform, truly phygital in all aspects, to avail of all the opportunities that are now gradually emerging in this hinterland as it becomes more and more aspirational.
Got it, sir. One more question, sir. Could you please throw some light on InstaCredit and how it is performing?
InstaCredit is again a long-term measure that we have taken. This is that as the bulk cash and with the impact of digitization as the volume cash in outlets, particularly in tier 1, tier 2 locations, comes down, we are providing an opportunity for every smaller outlet where some cash is there. And we pick up the cash and provide instantaneous credit like a UPI transfer, so that there is, the moment you walk away from the outlet and thereafter there's no risk factors involved for that particular outlet, and they've already got the money and they see it reflected in their account. So this is the model that is being extensively followed in the developed world today, where digitization has gone up to as high as 72-75%. But even then, large cash logistics companies have over 8,000, 10,000 outlets in every large city, greater area. They are based on providing instantaneous remittances for whatever some cash that is getting picked up from there.
Got it, sir. And one final request, sir. Like the way you are providing the logistics details for your cash management business in one of the slides, could you please provide something similar like that for the DBJ business as well? The number of people points, the volume of cash.
The feedback is noted. It is insignificant in terms of revenues, and hence we have not started disclosing. In a sense, we are expecting, as we committed, that we are expecting it to be breaking even from this in this financial year. We'll start disclosing that at that point of time.
Got it, sir. And the reason I ask is that as an investor, right? So I'm only hearing this that there's a break-even point coming and so on, right? So in the meanwhile, it would be very helpful for me to know that there is progress in this line of business, and so then sooner or later that break-even point is coming, and therefore the EBITDA will improve and so on. That is my request. And one final suggestion, I'll just leave it, sir. So the share price is nearly half of what it was a couple of years ago, sir. Maybe the promoters can signal to the market about their intention about the business by buying some shares from the market, sir. It would just send a positive signal to the market. I'll just leave that thought with you, sir. Thank you.
Your point is well taken, and we are very sensitive to all the shareholders. And it's just that, the company is currently in a state where we have planted some seeds for the future. which are being carefully attended to, and there would be a certain gestation period before each of these activities start bearing the kind of fruits that we are looking at.
Thank you, sir.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Chandramouli Jagannathan, an individual investor. Please go ahead.
Hello?
Sir, you are audible.
Hello?
Yes, sir, you are audible.
No.
Hello, can I?
Yeah, please go ahead now.
Hello, sir. You were talking about the POS machine incrementally 1 lakh, which you are expecting in H2, right?
That's no 1 lakh for the current year. So more than 1 lakh for the current year. We did about 14,000 in this quarter and about 4,000 in the first quarter.
Okay. So overall, will you be in a position to go beyond the last financial year PAT, this financial year 26, sir? I mean, you are talking about the better second half.
We are planning to reach to that level, make some nominal profits in the current financial year.
And the valuable logistics, the RBL, what about the loss till now, sir? And you said that you will be EBITDA positive. Is it for the second half or the whole year?
No. In the second half, probably, in the second half we'll achieve break-even. That's the expectation.
What would be the break-even top line, sir, which you might need for a quarterly basis?
A crore a month is the kind of revenue that we should hit.
Okay.
1 or 1.2 crores per month is where the break-even levels will be at this point.
Our competitor is talking about the large PSU bank ATM which is coming in, things like that. Is there any color on that, sir? Some PSU banks are coming up with...
we are not in the ATM segment at all, Mr. Mohan.
Okay. Thanks. That's all from me. Thank you.
Thank you. The next question is from the line of Abhishek Chawla, an individual investor. Please go ahead.
Regarding the direct clients, so I understand these clients are having their bank accounts in the bank which does not offer the cash management service. So I just want to understand, is there a risk when, let's say, the PSU bank starts offering this service and they give that route or particular contract to another competitor? So do we have the risk of losing that client at that point?
No, I would be very happy to be in the situation when a public sector bank start offering this, because the number of clients that they will be able to offer this service will be vast in number. Today, all PSUs except SBI, I think they have a market share of close to 55-60%. And if they start offering this, that will open floodgates of business for us. And on top of it, see, the direct business is where we have a contract with the customer. As long as the customer is happy with our service, there is no reason for him to migrate. Our pricing, whether direct or through bank, is largely the same.
Okay. Just to understand, like even if that event happens, the upside will mitigate even if we lose a few points because that route is not beneficial, that route is being serviced by some other competitor. That's it.
That's right. Yes.
Yeah. Thank you. That's it.
Thank you. The next question is from the line of Sudhit Samanta, an individual investor. Please go ahead.
Good morning, David, sir.
Good morning.
I have 2-3 questions. First of all, Q4 Concall, you guys say this year our target would be revenue target 15 to 18%. H1 end we achieve only 204 CR. So how we can achieve, sir, 15 to 18%? It's difficult, I think. This is the first question.
Yeah, at a consolidated level, our it is going to last year full year consolidated is 433,
Right.
and may not meet the exact target, but it will be closer to that. It's not going to be sharply different.
So it would be better than last year or similar to last year?
Definitely better than last year.
Okay, and what would be our EBITDA margin, sir, going forward?
See, we've not given specific EBITDA guidance for the remainder of the quarters. First quarter to second quarter, there is an improvement, and we are definitely confident that the second half EBITDA margins will be much better than the Q2 margins. Much better.
Okay. Thank you so much, sir.
Thank you. The next question is from the line of Madhur Rathi from Counter Cyclical Investment. Please go ahead.
Sir, thank you for the opportunity. Sir, in our Ace Money subsidiary, sir, who would be our competitors in this segment? And sir, when we say that this segment is a better margin business, what is the margin profile expected when we achieve a steady state on this business segment?
Specific competition names I would not like to mention, but anybody who provides financial solutions to retail outlets, smaller shops, etc., could be considered as our competitor. The margin profile there, see, where we come from, where our strength is in the presence in the tier 3, tier 4 locations, remote locations like Northeast, Jammu and Kashmir, etc., where we think we will have a intrinsic advantage compared to any other existing players. The second question about the steady state EBITDA, steady state margins, there are two parts to it. One is where the transaction revenues have a much healthier gross margins compared to our POS machine revenues. At a combined level, I think that business in a steady state can generate about between 15 to 20% EBITDA margins.
Sir, so our retail cash management business was doing upwards of 20-25% margin, and this segment is expected to generate 15-20% margin. Sir, so is the working capital need or is the capital employed lower in this segment versus that segment, or I'm just trying to understand from a capital allocation policy.
The capital employed will be lower in this business as well, and so in terms of return on capital employed, this will be fairly healthy. Ace Money will be fairly healthy.
Okay, got it. So just a final question, sir. One of our peer AGS Transact went bankrupt, sir. So has there been any white space that we expect to bank on? And sir, how is the market environment currently? Are we able to capture the share, whatever in segments we are present, where because of AGS going bankrupt, we can gain over the next 1.5 years?
Is not a peer. We hardly have any line of business which is common with AGS. They are more in the ATM segment, and we are not present in that segment at all.
Okay, got it, sir. So that was from mine, sir. Thank you so much and all the best.
Thank you.
Ladies and gentlemen, that was the last question for today. We have reached the end of question and answer session. I would now like to hand the conference over to management for closing remarks.
Thank you very much, Raju. The performance for the quarter has been muted and due to significant losses in our new initiatives of RVL and Ace Money, coupled with the muted performance of our core business. Our new initiatives are like seeds planted which demand patience and are taking a little time to grow. I am excited how we are today maturing into a hybrid phygital platform catering to the entire suite of cash and cash-related products. With a strong presence in over 15,000 PIN codes, our deep reach into India's hinterland positions us strongly to utilize every emerging opportunity in these areas. The management is conscious of its commitment to its shareholders, and we are taking several measures to grow the business and improve profitability. With renewed focus on sales initiatives across all the verticals and strident cost reduction measures, we are confident of improving the performance in the ongoing financial year. I want to express my gratitude for your continued support of Radiant. We are confident that our continuous efforts will yield promising results for all stakeholders. Thank you all for your time and your continuing interest in your company. Thank you very much, Raju.
Thank you. On the behalf of Antique Stock Broking Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.